In the last 100 years, the U.S. stock market has crashed more than 20%, 12 separate times. 12 times the headlines said crisis. 12 times investors panicked. 12 times the financial world felt like it might not recover. And 12 times, it did. Every single time. Today, I want to walk you through what actually happened during each of those moments, and what it means for you as a freelancer building wealth right now. Welcome to Freelancer Retirement Lab. I am the parent of a freelance creator who has spent years studying personal finance. This channel is the translation of everything I found into the language of the freelance economy. Subscribe. New videos every Tuesday, Thursday, and Saturday. A tour of every major crash. Let me take you through the PSNA history. Not the scary version. The real version. The Great Depression, 1929 to 1932. The market fell approximately 86%, the most severe crash in recorded market history. And yes, it took around 25 years to fully recover. Bears use this example constantly. The market can fall 86% and take 25 years to recover. How can you say it always comes back? Here is what they leave out. An investor who applied dollar-cost averaging through the Great Depression, buying at the lowest prices in market history every single month, participated in the extraordinary post-war economic expansion that followed. The long-term return for patient, consistent investors across that entire period was exceptional. The 1987 crash. Black Monday, October 19th. The market fell 34% in a single day. One day. Investors who sold that day and moved to cash, waiting for the safe re-entry, earned around 6% in a money market while the market recovered 55%. The dot-com crash, 2000 to 2002. The Nasdaq, heavily weighted toward technology, fell 78%. Brutal. But here's the thing. A broad market index fund like VTI fell around 49%, not 78%, because it owned thousands of companies across every sector, not just the tech bets that collapsed. Diversification worked. Exactly as designed. The 2008 financial crisis. The S&P 500 fell approximately 57%, $230 billion pulled from equity funds at the exact bottom. Recovery, approximately 5 years. Then, 400% growth over the following decade. The 2020 COVID crash, 34% in 33 days. The fastest 30% decline in market history. Recovery, approximately 5 months. 5 months, then new all-time highs. The pattern is clear. The timing of the recovery varies. The direction never has. The specific cost of selling at the bottom. Let me make this specific rather than abstract. A freelancer in 2008, $50,000 in a total market index fund. The market falls 57%. Balance, $21,500. Two choices. Scenario A, hold, keep the automatic $500 monthly contribution running through the decline. By 2018, 10 years later, balance approximately $198,000. Scenario B, sell in March 2009, move to a money market account. Reinvest in 2012 when it feels safe, missing 3 years of the recovery. By 2018, same 10 years, balance, approximately $124,000. The decision to sell at the bottom cost $74,000, not from the initial fall, from missing the recovery. $74,000 from one decision made at the moment of maximum fear. Why? Why the recovery always follows. Here's the question worth asking. Why does the market always recover? Is it luck? Is it a guarantee? It is neither. The stock market is not a casino. It is a collection of ownership stakes in real businesses. Businesses that make products, deliver services, employ people, innovate and adapt. Market declines happen when fear drives investors to sell ownership in those businesses below what they are actually worth. The price falls below the value. But the business keeps operating. The revenue keeps coming. The gap between price and value eventually closes. That closing is what the recovery looks like. The investor who sells during a decline is selling real business ownership at a discount. The investor who holds, or buys more, is acquiring ownership at a discount and waiting for the price to reflect reality. This is not optimism. This is 100 years of documented history. The time horizon is the protection. Here's the angle specific to freelancers. If you are investing at age 30, you have approximately 35 years before retirement at 65. Within any 35-year window in U.S. market history, the total market has never produced a negative return. Never. For a freelancer with more than 20 years until retirement, there is zero historical scenario in which staying invested in a broad index fund produced a worse outcome than selling and holding cash. Zero. The time horizon is the protection. You do not need certainty about when the recovery comes. You just need to hold long enough for it to arrive, and the data says it always does within your investment lifetime. The written rule. So why do people still sell at the bottom, if the history is this clear? Because knowing something intellectually is not the same as feeling it emotionally. When the portfolio is down 30% and the news is grim and friends are talking about moving to cash, the intellectual knowledge that markets always recover does not feel like much comfort. This is where the written rule changes everything. The investor who holds through every crash does not hold because they are emotionally stronger. They hold because they made the decision before the crash, when they were calm, and they wrote it down. The document says, if markets fall, I hold. I keep contributing. I do not sell. When the crash comes, they do not make a new decision. They follow the one they already made. Your calm, rational self, written down in advance, is more reliable than your fearful, reactive self deciding in the moment. Always. The number that matters. Let me give you the number that puts all of this into perspective. An investor who missed just the 10 best trading days in the U.S. market over a 20-year period had approximately half the return of an investor who held through every single day. 10 days. Out of approximately 5,000 trading days. 10. The best days in the market almost always happen during or immediately after the worst periods. The investor who sells during the fear misses the recovery rally, and missing those 10 days cuts their 20-year return in half. This is why staying invested is not passive. It is the most actively important decision you make. Your action steps. This week, look up the historical performance chart of VTI or FSKAX. Go back to 2008. Note where the bottom was. Note what happened in the 5 years after. Go back to 2020. Note the March bottom. Note what happened in the 5 months after. Now look at where the fund is today. That chart is your investment policy in visual form. Every crash, every recovery, all of it in one picture. Save it. Look at it the next time a decline tempts you to act. 12 crashes, 12 recoveries. The investor who held through every one of them did not have special insight or superior willpower. They had a simple understanding of one historical truth. The market has recovered from every decline in recorded history, and a written rule that prevented their biology from overriding that truth at the worst possible moment. Holding through a crash is not inaction. It is the most evidence-backed investment decision available. The inaction is what generates the wealth. Have you ever been through a market decline and held steady? Or did you sell and regret it? Drop it in the comments. Honest answers only. And if this reframed what it means to stay invested, tap the like. See you next Tuesday.